Hello and welcome to a discussion on variable cost and absorption cost income statements. After viewing this video, you will be able to prepare a variable cost income statement and an absorption cost income statement. You will also be able to explain and reconcile the differences in income between the two statements. Let's talk about the variable cost income statement first. This statement sorts costs by variable and fixed and is also used to do cost volume profit analysis. Variable cost is a different name for a contribution margin income statement. It begins with sales and then subtracts all variable cost. Variable product costs are sometimes separated from variable period expenses in order to determine the product contribution margin on sales only. All fixed costs are subtracted from the total contribution margin. All fixed cost includes fixed manufacturing overhead. The total variable costs are computed as the per unit amount multiplied by units sold. Always multiply by units sold when computing total amounts on the income statement. The important things to remember about the variable cost income statement are that it separates cost first by variable on top and second by fixed. The next thing to remember is that fixed manufacturing overhead is treated as a period cost, and all of this cost is expensed during the period. Management takes the approach that the fixed overhead was incurred to produce all the products, and the number of units in inventory has no impact on this cost. This is a cash flow perspective. Management is more concerned about the fixed costs that are actually incurred during the period than following the matching principle. This statement is used for internal purposes only. The absorption cost income statement separates costs by product and period. All product costs, including fixed manufacturing overhead, are matched to sales in order to comply with the matching principle. All period expenses are expensed in the period incurred. Total sales and cost of goods sold is always computed as the amount per unit multiplied by the units sold. There are a few things to remember that will help you prepare the absorption cost income statement. First, this statement is in accordance with GAAP because it follows the matching principle. Second, as we have previously discussed, cost of goods sold is made up of all four product costs: direct material, direct labor, and variable and fixed manufacturing overhead. The total amount is computed as the number of units sold multiplied by the amount per unit. If product costs are given in total amounts, divide the total cost by units made and get the product cost per unit that must be used. Do not just use total product cost on the income statement. Some of the product costs may be in inventory and not yet sold. As we have learned previously, period costs are always expensed in the period incurred. The difference in absorption cost income and variable cost income is how fixed manufacturing overhead is reported. Absorption cost reports the fixed manufacturing overhead cost related to units sold only. The fixed manufacturing costs to make units not sold are included in the cost of inventory on the balance sheet. This accomplishes the matching principle. Total fixed manufacturing overhead is reported on the variable cost statement in the period it is incurred. This statement ignores the matching principle and treats fixed manufacturing as a period cost, even though it's not. The key thing to remember is that it reports it like a period cost, not that it becomes a period cost. Manufacturing overhead is always a product cost. Operating income will be the same on both statements only when units sold is equal to units made. The total fixed manufacturing overhead incurred is the same as the total in units sold. A difference in income between the two statements is due to a different quantity of units made than units sold. The costs that represent the change in inventory is reported on the balance sheet rather than the absorption cost income statement. The change in inventory in units multiplied by the fixed manufacturing cost per unit will be the difference in the two incomes. Both income statements are prepared using cost per unit. If you have total amounts and are not given the cost per unit, you must first compute the cost per unit. The cost per unit is always multiplied by the units of sales. For product cost, always divide by total units made. For period cost, always divide by total units sold. Let's walk through a quick example of how to prepare the absorption cost and variable cost income statements and reconcile the difference in income. In this example, all variable costs are product cost, and variable costs are given per unit. Fixed costs are given in total. The quantity of units produced is different than units sold, which will give different incomes. The units in beginning inventory only matters if the company sells more than they produce in the current period. Let's do the variable cost income statement first. This statement sorts costs by variable and fixed, and treats manufacturing overhead that is fixed as a period cost. Take a moment and notice the format. Notice that the amount per unit is multiplied by the quantity of units sold. Now let's work on the absorption cost income statement. This statement sorts costs by product and period. All product costs use a cost per unit that is then multiplied by the quantity of units sold. This matches the product cost to the sales and accomplishes the matching principle. The first step is to take the total amount of fixed manufacturing overhead and compute the cost per unit by dividing the total units made during the period. This statement sorts costs by product and period. Begin with sales and subtract all four product costs. Make sure to multiply the per unit by the units sold. Then subtract all period expenses. Period expenses include both fixed and variable. Let's summarize. Variable cost income was $34,000 and absorption cost was $39,000. There is a difference of $5,000 in income on the two statements. The difference will always come from the cost of fixed manufacturing overhead in inventory. The company made 1,000 more units than they sold, and inventory increased by 1,000 units. The cost of fixed manufacturing inventory that went to the balance sheet in the 1,000 units is $5,000. This $5,000 cost is reported on the balance sheet and is not on the absorption cost income statement. Less cost on the income statement gives a higher absorption cost income. After viewing this video, you should be able to prepare a variable cost and an absorption cost income statement. You should also then be able to explain and reconcile the difference in income between the two types of statements. Please log on to studymyaccounting.com. The practices you learn will give you more examples of the concepts discussed in this video. Work the practice test to verify your understanding. Please write the answers out and then check your answers to the answers and explanations provided. Thank you for being prepared for class. It is much appreciated.